Good afternoon, everybody, and welcome to today's Friday live webinar. My name is Emmanuel Akinola, market analyst at HFM Nigeria. Thank you for joining us today. I hope everybody is doing well. How's your Friday going? Please let me have you know that you can communicate with me with the Q&A. It is currently enabled such that you can communicate with us. Whenever you have questions, you can let us know, and that would help us hear from you and also get your feedback in situations where you have a question or you have something that you'd want to call my attention to. Please use the Q&A. Thank you. All right, before we head into what we have for you today, it is important that we have a very great foundation as we speak about the concept of price structure today. Price structure, particularly talking about chart patterns. Price structure, chart patterns. This is a topic that a lot of people have put in requests for over time, asking us to discuss price structures, asking us to discuss a little bit about charts, candlesticks. I think the day is here, and we should be able to do justice to a greater extent. You should be satisfied at the end of the session today. If you have friends, you have families, you have people, traders like you, close friends, close traders, people that you mentor that might need to be on this live, now is the time to share it to them, share it to everybody, let everybody know that we're about to have a very interesting discussion on price structure today. Let me start with this. The bedrock for me, when it comes to technical analysis, is studying the behavior of human beings. To a greater extent, if you understand that the market itself is traded by you and I, human beings, and then we need to understand how traders tend to make their decisions, especially when it comes to the chart. It isn't a surprise that almost everyone who trades the global financial market is technical inclined. I mean, especially from this part of the world, we find more people who learn so much about technical analysis and how technical analysis can help us to make decisions in the market. But people tend to miss the connection between technical analysis and the market. In fact, people tend to not understand how to make it better. My job today is to show you the things you already know. Most of you are already accustomed with most of this concept of price structure, candlestick patterns, chart patterns. My job today is to show you how it could be better. My job today is to show you what you need to add to it to make it better. My job today is to show you how you can use those things that you already know to make good decisions in the market. How do you understand the idea behind the concept? For most people, what they know is the concept. They don't know anything outside the concept. And it becomes a problem if I am rigid enough. For example, someone told me that if I see this in the market, so someone said to me, if I see something like this in the market, just as an example, someone is saying to me, if I see this in the market, please stay with me. Stay with me. We're trying to establish something. So someone is saying to me now, if I see this in the market, that this is called a bullish engulfing pattern. So someone is saying to me, right, that if I see this, it is called a bullish engulfing pattern. And that if this comes up on a downside, it could be a signal that prices would move back up, which means more or less like a buying signal. So, fine, established. If I see this or something like this, I should call it a bullish engulfing pattern. And then what it means for me is there could be an opportunity for me to take a buy because prices should rise. All good and fine. The question behind this that a lot of people would not ask is this is a concept that someone had seen established and has given to you, and then you also will just take it as given and just say, anytime I see something like this, I'm just going to buy because it means prices would rise. The question now is it every time that someone will even see this? So am I going to be searching through charts, trying to look for a bullish engulfing pattern? So will I sit down on multiple charts now, trying to see if I can find a bullish engulfing pattern? Is that what I'm going to do now? Would I start looking for it up and down on every chart? Because someone already said, if I see something like this, it means there could be an opportunity for me to look for further upsides in the market. But what is behind this concept? A lot of these patterns that we know today, bullish engulfing, bearish engulfing, reversals from double top, double bottom, hanging man, shooting star, marubozus, long leg dodges, every single one of them, as we know it, established pattern. Someone has said, if you see this, this is what it means. So do we then go about looking at every single chart, trying to find out if we can see this, and then we can use it to then make a decision in the market? It isn't a problem if you go around looking for the pattern itself. But the truth is, it can be better. it can make a lot of sense to you, it can be better. So let us first start by understanding the idea behind price structure. And then we move on to understanding the idea behind candlesticks. And then we're going to move on to understanding the idea behind candlestick patterns. And from there, we're going to end the session with understanding the idea behind candlestick and chart patterns and making decisions with them in the market. So let us start with this. In the first place, whenever you're thinking about the chart, one thing you need to always remember is the chart is showing you the relationship between buyers and sellers. That's one thing you never want to forget. Whenever you look at any chart, what you're looking at is the relationship between buyers and sellers of that particular asset. That's one thing you want to always remember. The chart shows the relationship between two people who are looking to make money from the same asset. Those who wants to buy and those who wants to sell, which means at every point in time, no matter what the asset is in question, you're talking about a market where you would be able to find buyers and sellers looking for opportunities to enter into the market. So every chart, what I see and what I expect you to start to see from today is the relationship between buyers and sellers. Always start with that. Don't forget that this business is a business where you get to speculate on the rise and fall of financial assets and financial instruments with the sole purpose of making profit, right? We remember that. And then we also remember that this reason alone is why we have the opportunity to buy and to sell in the market too. And for this reason also is the reason why in the market you have what you call a bull candle and you have what you call a bear candle. Candlesticks are not called red and green candles. Candlesticks aren't called blue and yellow candles. Candlesticks aren't called by colors. They are called by identification. You are either a bullish candle or a bearish candle. Why? Because the chart itself shows the relationship between buyers and sellers. And buyers in the market go by the name bulls. That is people who are mainly interested in buying this particular asset or instrument, and then bears those who are particular about looking for a fall in the movement of prices in the market. So when we talk about candlesticks, we are talking about a representation of people who are buying and who are selling. That's the beginning, and one thing you must always remember whenever you think about the chart, or whenever you're thinking about candlestick patterns, or you're thinking about chart patterns, always remember everything is still coming back to the relationship between buyers and sellers. Everything is coming back there. Everything. So when we establish the fact that the chart itself, the market itself, is the relationship between buyers and sellers in the market, then it makes a lot of sense for us to understand a host of other things in the market. Are you still with me? Now, when you understand up to this point that irrespective of the color of the candle, irrespective of what type, what formation. We need to get the reason behind the concept. So now we've established that every chart talks about the relationship between buyers and sellers, right? Great. Now, if we now know that this expanse is talking about how buyers and sellers relate on the screen. So, for example, it means I can begin to make deductions like this in the market. What kind of deductions am I talking about, right? I can begin to say things like this. I can say, oh, I can say something like this, that I could see a movement of price lower this much. Now, instead of me to say, the market has been falling, or say something like, the market has been selling, or say languages like, the market has been trending downwards. There's been a downtrend. I could use a simpler language to say all of that because I understand the concept behind this thing. Because I understand the concept behind this thing. One thing you need to understand is I can say something like, this market is controlled by sellers. So I could say at this point, it means sellers were in control. I could just say that. I could just tell you, oh, this movement clearly showed that sellers were in control of prices in the market. I don't need to say it was trending lower. I don't need to say it's a downtrend. I don't need to say prices was falling. I can just tell you, it just means sellers were clearly in control of price movement. Because I understand that the chart is the relationship between buyers and sellers. So if prices are falling, and not only is it just falling, it is falling over a long period of time. It is only saying one thing: sellers are in charge. So now we're getting somewhere, right? We're getting to the point where we are realizing that the system does not need to be complicated. It could be simple enough that you understand most of the rationality behind the system, and then you're able to trade better. Now, let's talk about how candlesticks are created. So we have a bullish candle and a bearish candle. Now, let me tell you something. Let me tell you this. Do you know that the difference between these two candles that you can see on the screen is not the color? Some of you will be surprised that the difference between the two candlesticks I've just drawn on the screen is not the color. The green and the red is not enough reason for you to say these are two different candlesticks. No, not in this market. What makes it different is the notion behind the movement. What are we talking about? For a market to sell, it means prices are going down. So for a bearish candle, it must be that it started from here, it opened here, And then it closed at this point because prices moved lower. But then for a bullish candle, which means prices are rising. For prices to rise, it means something went from down back up. So it means for this candle, it started at this point, opened here, and closed here. Ladies and gentlemen, this is when there is a difference between the two candles. Because now, what you are seeing here means if a candle opened at the top and closed lower, it means there was a fall in price. That's what it means. It means there was a fall in price here. So something started from the top and it moved lower. So that is why it's a bearish candle, clearly showing the activities of sellers. A bearish candle clearly showing the activities of sellers pushing prices lower. So the candle started from the top, it closed lower, clearly depicting a fall in price. And then for the bullish candle, the reason why it is different because this one is showing the activities of buyers in the market. Buyers are traders who want prices to rise. That is, they move prices from low back up. And that is the only difference here because this one also is showing that prices moved from down back up. That is the only difference between these two candles. It is not the color. The color has no reason to be the difference because I can even make both of them red if I want. If you want, if you want, you can make a bull candle red. The system will not reject it. Maybe some of you think the system will say no. The system will never say no because the difference still exists. A bullish candle forms from low to the top. A bearish candle forms from the top back down. So even if they are of the same color, it can still be separated by the movement. It can't be separated. So we are not color traders. We understand the notion behind the movement. So I'm not a trader of red and green. I'm a trader of understanding that for prices to rise, it goes from down back up, and for prices to fall, it goes from up back down. Let's start with that understanding first. Now listen to this. But you see, when prices are either rising or falling, there are some points that prices will get to some places it cannot stay, or where it gets rejected, or places where price, potentially tested, but it moved maybe lower beyond the level or above the level. So there could be situations where prices moves way beyond this point. There could be a situation where this candle goes as high as this. But for one reason or the other, the market does not allow it, eventually close at this point. And eventually this same candle shrinks back to remain at this particular level. But you see, that movement to the top will not be deleted. It will be shown with a wick like this. We call it a wick, or some people call it shadows. But what it really is what we call evidences of price action or price movement. Wicks are evidences that prices got to a particular point, but for one reason or the other, the price could not close at that point. It means this candle at one point in its lifespan got to this point, but it could not stay there. For either one reason or the other, it could not stay here. It was rejected. But the market cannot delete the evidence. The market cannot say, because you're no longer here, let us disappear away from that point. No, it's not possible. The market must leave evidence that, listen, price was here at this point, and it might be something valuable for you to make a decision. That point here is called, let me use another color, high. And this one, the one that goes lower, which means at some point the candle could have started as a red candle, could go lower a little bit. That other one is called low. Low. And the reverse is the case for a red candle. It just reverses itself. Did I say reverse is the case? No. Because this remains, sorry, high and low. Now listen to this. So this is the formation of a candle. The highest point the candle has gotten to, price leaves evidences of that. The lowest point, price leaves evidences of that. And then we have the open and the close. Now, don't forget, I said there's something called wicks, right? Which naturally evidences of price action. That's the name I called it. There's a reason why I call wicks evidences of price action. There's a reason why. Imagine if a candle was forming this way. Stay with me. Imagine a candle forming this way that gets this high, moving from this point to this point, right? Which clearly shows that buyers had pressures, right? There was crazy buying pressure. For a candle to be this big as a dream candle, it means the pressure of buyers in the market was so strong. It was so strong. They kept pushing price up. They kept pushing price up. And then this same candle that you have seen this way ended up in this shape. Can you imagine this? Please just imagine this with me. A candle that showed this much pressure in terms of buying, like the pressure in the market was so high And out of nowhere, the market could not hold on to that same level of pressure. Buyers could not hold on to the momentum, and this same candle closed this way, which means more than half of the price movement to the top was wiped out. Don't forget, there are only two people in the market. There are those who are buying, and there are those who are selling. It means if buying pressure was this high and suddenly that same candle turned this way, it means there were some pushbacks. One way or the other, the opposition party put up a bit of resistance. The opposition party started coming into the system to say, no, now, no, now. You cannot just be going now. Because if I bought up to this point and out of nowhere, something was able to push me down back to more than half, something must have happened. That is the idea. Something must have happened. There must have been some roadblocks. There must have been some pushback from the opposition party. The same thing goes for if it was a sell candle the other way as well. You could see a situation where a red candle this big could eventually end up as something like this. The question you should ask yourself is, what could have happened that a candle with this much body ended up with almost half of the move wiped out? Ladies and gentlemen, there is only one answer. There is price action. That is, there is pushback between buyers and sellers. This, for one, means sellers put up an opposition. And this, for one, means buyers stepped in. Listen to this. Listen to this. What we are saying is naturally, naturally, naturally. Weeks are evidences of price action, naturally. They are evidences that the opposition side is putting up a little bit of resistance. It's putting up a little bit of fight. It's showing that there's something. We cannot just allow you just take charge. And that's why almost every pattern that you know in terms of candlestick pattern, they have wicks one way or the other. Wicks is one of the reasons why they are like that. Call me a liar. Almost all the candlestick patterns relies on wicks, the movement and the formation of candles, maybe an half-bodied candle followed by a big-bodied candle. It is simply talking about the relationship between buyers and sellers. If there was this much pressure before, and this pressure now turned to this smaller thing, it means this opposite party is coming into the system. This is what gives birth to all those reversal patterns that you think you know. The reversal patterns are not necessarily because of the way the candlestick form. It is because of the notion behind how buyers and sellers are now looking to set up opposition for the initial movement. The evidences of those movements is the week you're seeing. It is the evidence that buyers and sellers are now at loggerhead in the market. There's almost no reversal pattern or continuation pattern that doesn't have something to do with weeks in the market. Why? Because that is the main evidence of price action. It is the one that shows that, listen, something is here. And get this, What causes some of these things to happen? For those of you who don't know it today. Listen to this. Which takes us back to the concept of support and resistance, right? For those of us who has been to lectures about support and resistance, as the case may be, as we know it, a resistance is a level where prices are naturally expected to fall, right? Now, so we know that anytime price steps into resistance, naturally we expect that prices, one way or the other, should not just find it easy to go beyond it. We know that. For those who don't know, we have a recorded video on YouTube already on support and resistance. But listen to this, right? So we know this, that naturally when price gets to a resistance, price should fall. Now, the concept of support and resistance is so popular. A lot of traders around the world understand this concept. A lot of traders around the world are conversant with this concept of support and resistance. So they know that naturally, when price steps into a resistance, it makes sense for them to sell. Here comes the mystery: pending orders. For some of you who don't know, pending orders get the usage and the concept from support and resistance. Because ask yourself, if you use a buy limit, it means you're buying at a price lower than the current market price. And then when you use a buy stop, it means you're buying at a price higher than the current market price, right? If you use a sell limit, it means you're trying to sell at a price higher than the current market price. And if you use a sell stop, it means you're trying to sell at a price lower than the current market price. You see, every of these pending orders, you can relate it down to support and resistance. For example, a trader who sees price moving somewhere like this, maybe prices just randomly going up and down, right? And then he starts seeing price approach a resistance. He just thinks, okay, if price actually gets to this resistance, he should sell. Maybe a host of other traders in the market also believes that prices would sell if it gets to that level of resistance. See, some people don't have so much time to wait for price to get to the resistance before they take their trade. So naturally, they want to put in a pending order to lock in a price around that level, such that when price gets to that particular level, they enter into the market. So we begin to see a lot of people start, tabling sell limits at this point. Sell limits, particularly sell limits. So a lot of traders, we start anchoring sell limits at that point. Sell limit will start going there. Even though price has not gotten there, remember, sell limit allows you to sell at a price higher than the current market price. So a lot of traders believe that from that point, price should fall. Some would already set pending orders. Some will be waiting to see some evidences or some confirmations before they enter their own sales, right? Now, for some people, when price starts to rise, like this, and then it gets to this level of resistance, the moment that price starts to trigger in sell orders or sell limits, the moment that price starts triggering new orders into the market for a sell, you will start seeing the reaction. and the reaction starts showing with weeks, you start seeing things like this. The same candle will become something like this. Before you know it, a lot of people have put in more cells. Before you know it, it reduces. It becomes something like this. Before you know it, it reduces even further. It becomes something like this. Now, those traders who has not entered into the sell because they are waiting to see if price would respect that particular level, they use these weeks. Let me use red to map it out. They use these weeks as their own evidences of price action to show that, okay, there are really sellers around this level. There are really people around these levels that also wants to sell. Okay, I can also go in for a sell. Because there are two sets of traders in the market. Those who are going to use pending orders to enter, irrespective of if there's confirmation or not, and those who would have to wait to see that there is signs that the market wants to fall from that point with the aid of price action. Now, if you now begin to talk about some of the candlestick formations that we naturally use to enter into our trades, like your bullish engulfing, like your shooting star, hanging man, hanging hammer, whatever the name is, and all of those, listen to this. It can be better. It is usually better when you see them around strategic points. That's where I'm going to now. It means those candlestick formations that you already know that doesn't seem like they are working. Let me tell you for a fact, I have some of them for you. I made a research before coming to class, like every good tutor should. Nobody has any island knowledge on the movement of prices or how the forex market works. So I made some research before coming to the class today, and I came with some pictures for you of some really nice patterns that you already know. The bullish engulfing, for example, a smaller red candle before a bigger green candle. You can see what it says. It says the bullish engulfing candlestick pattern indicates that buyers are now in control. Why? Because a smaller red candle has now been completely overtaken by a bigger green candle, isn't it? And that the number of buyers has outweighed the number of sellers. Can you see? They are still talking about buyers and sellers, human beings, not machines, not the candle itself. But listen to this. These patterns, you cannot just be going around in the market looking for a bullish engulfing. You just want to see a smaller red candle and a bigger candle that was green after, and you just say, yes, bullish engulfing. It means price will go up. It's going to be a problem. Let me tell you why. Let me tell you something. You see, every of this pattern that you're seeing right here on the screen, like a twisted top bottom as well, for example, let me tell you something. Every of this pattern that you can see on the screen, when I was doing my research, I saw that most of the candlestick patterns, they have less than 60% probability of correctly predicting price movement. I was shocked because I'd never even checked the probability before. Because this website was saying, according to, research, statistics done by University of Michigan and some other reputable sources, Most of those patterns that you see people holding with so much high esteem that they just only base their trading off in the market, most of them have less than 60% probability of correctly predicting the movement of prices in the market. Almost all of them over around 50, 55, 52, 50, 55, 52, 58. Few of them are above 60. In fact, the highest I saw was 70%. So when I begin to see people who only trade the candlesticks pattern itself, I just wonder, what do we do to help you? And that is the purpose of this particular lecture. How can you use it better? Yes, we have the bullish engulfing, which is usually a reversal pattern for a buy in the market. Usually it's something that allows us to buy off a downtrend. The same thing goes with a tweezer bottom. Also, when two candles, opposite colors, bullish candle and a bearish candle of almost the same size, forms after a downtrend or a bearish price movement, also helps us with a bullish price movement in the market. And the third one that I brought for you today is the morning star. All right, usually a combination of just empty candles, three empty candles majorly, but these three candles, the morning star, the tweezer bottom, and the bullish engulfing candle, three of them, I brought them for buys of a downtrend. There are other ones, but for me, I only brought the ones with at least 65% success rate according to good sources. These three, according to sources, they have 65% minimum good success in usage. The bullish engulfing, the tweezer bottom, and the morning star. But now, ladies and gentlemen, let us make that 65%, 90%. Are you with me? Let us make that 65%, 80, 85, 90%. Stay with me. Let us make it better. You know how we do it at HFM. We don't want you to trade things blindly. So how can it be better to use some of these patterns that you already know? How can it be better? Let's go. Let's do some analysis together. Listen to this. It is not every downtrend that will reverse. That you're not looking for a reversal pattern somewhere around here. Maybe bullish engulfing, or you're looking for what's it called? A tweezer bottom or anything that helps you with a buy signal here in form of a candlestick pattern, right? The truth is, not every downtrend of movement of prices lower would result in a reversal. So you cannot just say that because you saw a bullish engulfing following a downtrend, that's the reason why you bought. You cannot just say because you saw a tweezer bottom following a downtrend or a movement of prices lower, that was the reason why you bought. You cannot also say that it is because you saw a morning star after a downtrend, that is the reason why you bought. No. Let me tell you how we can use it better. Number one, establish that there is actually a reason for you to expect upside. What this means is, don't take the buy just because by default they said if you see this candlestick pattern, it means prices will buy. Don't do that. Don't do that. The first thing you need to do is to first establish that there is actually a reason for you to expect upside on that asset. It could be a fundamental reason, maybe from information. It could be a sentiment reason, maybe from a change in market mood. It could be a reason from maybe a data release in the market. It could be anything, but find a reason why you think prices should rise from that point, not because of the candlestick pattern itself. No. Establish that you actually have a reason why you expect prices to go up. When you do that, scan and draw out good levels of support and resistance. That's the second thing. Establish that there is actually a reason. Oh, did I just spell reason as R-E-S? A reason for you to expect upsides. And then you have to also scan and draw out good levels of support. Maybe I should move the resistance for now because I'm talking about buying. So let me use support. Good levels of support alone for now because I'm talking about buying. If you see any of the bullish reversal candle pattern, you can take the trade. Ladies and gentlemen, with this, you're getting yourself closer to at least about 80% success rate of using candlestick patterns that you know. If you remove your eyes from just trading it blindly. It means if I see a downtrend, for example, and then I find reasons why I should buy, all I need is good levels of support and resistance. Thank God we have an example on Euro USD. We can use it. Now, look at this much downside on Euro USD. If every single day you see this downside and then you see a bullish engulfing and you bought it, you would have lost because every single day price continued to go down irrespective of the kind of candlestick formation that you're seeing. It does not matter. Why? Because the market was clearly showing that the dollar was a strong currency, and every single day it kept making more strides against the euro. But it got to a point, the dollar strength started to fade, especially with a string of bad data reports. So we started seeing some negative data reports for the dollar. Jolt's job openings was bad. It was not good. We also saw an increase in unemployment claims. It wasn't good. We also saw that NFP also was poor. So as at that time, we saw that the strength of the dollar started to wane. Now, if I come to Euro USD with the understanding that the strength of the dollar is no longer what it used to be, now I'm looking for a reason to buy, which means I have established a reason why I expect prices to go up. Why? Because data is starting to show that the dollar is expected to lose value, which means I can buy the euro against the dollar. So I have established a reason. All I need now is good levels of support and resistance to come into the system, right? Let me show you something. If you look at this level, where we saw that price changed direction from a nice downtrend back up, you would see that it's a level from the past that has a strong affinity for price action. Look at it here. From a down, it changed back to up. Also, again, from a down, it changed back to up. So now that we can also see this, and we have backing now. Remember, we found the backing. We established the reason why we expect prices to go back up because of new negative string of data for the dollar, which means we are interested in buying Euro USD. Using this particular level from the past as support, drawing it into the future at that time, means we found our good level of support. All we need now is the evidences of price action to enter into the market. It could be a simple week, but it could be any of the reversal patterns that you know with candlesticks in the market. For example, let us expand this and see what you have there. Look at this. Look at this here. Look at this here. You'd see that before the market eventually changed to an uptrend, the market gave us signs. It gave that reversal sign. It gave it. It showed us that, okay, it is time. But do you know that even before we had some of those reversal signs, and yet the market never created an uptrend? It still just rose up a little bit and crashed. The only difference is all this while, there was no reason for us to buy. There were only reasons for us to continue to sell. But you see, the moment you establish the reason to buy and you find a good level of support and you see any of the reversal candles patterns that establishes buys in the market, like this one, the morning star, or you see a tweezer bottom, or maybe you even see an engulfing candle on that particular level, listen, it would make so much sense. It would make so much sense. It would make so much sense. Not just that you are just every single time you see that pattern, you just think it means buy. No, no, make it make sense. Establish the reason why you think that price should rise. One, then make sure that particular pattern is forming on a good level of support. Enter into your trade. If you find it, it will make a lot of sense. It will make a lot of sense. Think about the opposites, the ones for sale, like the hammer. Also, this also is for a buy, by the way. The hammer also works for a buy. An empty candle like this also in a downtrend on a support can be a very good signal in the market. Could be a very good signal if this forms on a good support when you are expecting prices to rise. This particular one. This is even the most common one to a lot of traders. People like me, I don't particularly look for all the reversal patterns when I want to buy off a good level of support. I usually look out for an hammer or simple rejection in terms of weeks in the market. Simple rejections could do. And then for a sell, we just reverse it. We have a bearish engulfing pattern, which is for a sell, a green smaller candle engulfed by a bigger candle. And we also have a tweezer top, just reversal of the one we had for a buy, which is just the same green and red candle forming around the same level. We also have the evening star, but apparently for this to also make a lot of sense to you, ladies and gentlemen, let me tell you something. We are going to rewrite this. You must also establish that there's a reason for you to expect downsides. You must also scan and draw out good levels of resistance. And then if you see any of the reversal candles, the bearish reversal candles, you can take the trade. This is how you can get these things to work from maybe 50% success rate before to at least about 75, 80, 85% success rate. Establish that there is actually a reason for you to expect downsides. Then scan the markets to see if you can find good levels of resistance. If you see any of those patterns form around resistance, that's a reason for you to go down. Take the trade. For example, look at this movement here. We'll do some other example. Look at this movement here on Euro USD. Oh my God, what a day that was. That was a single day movement, guys. A day, one day. That was just a single day movement. But do you know that you could have seen this coming? How? Because this happened because the market believed that Trump's election victory was going to be good for the dollar, which means naturally, naturally, you should sell Euro USD if Trump was going to win the election. So that movement was not a trick movement. It was not a movement out of nowhere. It was an expected movement. And you'd also see that it wasn't a movement out of any random point in the market. It wasn't. It was a movement from a good level of resistance. It's a level that has enough price action that you can trace it to. Look at it. That movement was not random. It wasn't. So if I had established a reason why I wanted to sell that particular instrument, why not? Look at the reason, establish it. Then make sure you first scan a good level of resistance. If you find any of the bearish reversal pattern, those are evidences of price actions for you. Enter into the trade. Enter into the trade. Enter into the trade. So close the chapter on candlestick formation and patterns because we need to quickly move to chart patterns itself. I want to teach you some of my personal favorites, but just quickly take this from me. The most important things you need to know about candlestick patterns, whichever one you're still going to go and study by yourself. Like I said, we only brought the ones that has at least 65% success rate according to leading sources in the market. So there might still be other ones that you know and you would love to use. Take this from me, it could be better. It could be better if you already know what direction you want to take in the market. Let me show you one of them. Real life example now. Real life example, like market is currently moving. Let me show you an example now. Look at this. This is Euro USD, by the way. And look at what you are seeing here. You're seeing a lot of empty candles. In fact, there is an armor, not necessarily, but like an hanging man, in fact, there's an inverted armor looking to form. But particularly, these two candles are showing you something. For those who are technical oriented on this particular live right now, if you see these two candles right here forming, what do you think? Just truthfully, if you were just on your seat, I'm not there, nobody is looking at you, you see these two empty candles with two long wicks forming, small bodies, which particularly forms a type of reversal candle in the market. What do you think? Please use the Q&A session to just answer. What would you just naturally think you should do? Naturally, wouldn't you just think, I think, this one forming now, my mean is time to buy because it's forming from his head, right? Isn't it the way every normal person who trades, who knows about candlestick pattern would think that this thing forming here like this might mean prices should go up. Let me just go and buy. Let me just go and buy. I'm not wrong because a lot of people are already confirming it in the Q&A. Yes, it's showing indecision, which means possibly buyers are about to take over from what sellers are doing. But you see, the problem I would have is when you are only buying only based off the indecision you are seeing from that particular candle formation. That's the issue I'm going to have. You would need to establish other reasons why you think you should follow this indecision that is showing in the market. Remember, I told you, if you're going to buy this, you have to establish the reason why you're interested in buying. Let's do that briefly. Briefly. We don't have so much time. Let's do that. So this morning, we wrote something about the US dollar, right? It says, let us talk about the US dollar this morning. Read this. It says, the dollar had a massive gap higher on Wednesday on Trump's election victory, but the market hasn't sustained that euphoria so far. We are seeing the dollar lose ground. Listen to that. The dollar had a massive move on Wednesday, but the market is not able to sustain it. The dollar is starting to lose some ground. It says unemployment claims came in higher than expected yesterday. The dollar lost value and was pressured across board. The FOMC decision did more damage as the Federal Reserve cut interest rate by 25 basis points as expected. That was yesterday. But Fed Powell's dovish remarks have solidified market expectation for another 25 basis point cut in rates in December. Also, another bad news for dollar. So we're just saying, listen, dollar had a good day on Wednesday, but since Wednesday, it's had a poor month. It's had a poor month. Sorry, not a poor month, like a poor week. Wednesday was good, but Thursday has not been so good. Even today has not been really good like that. But then it says the USD index, which is this one, right? The USD index, which actually shows the performance of the dollar against a basket of other commodities or assets in the market, with a key technical break below the support around 104.40 before the 50 MA blue line stepped in to stall the decline. It says we are seeing price test the 104.40 level as a resistance now, considering the current fundamentals. If this level holds, we can't rule out further downsides for the dollar, which means in one breath, we're saying that, man, what is going on with the dollar right now is not looking so good. There's the possibility that the dollar would potentially lose grounds in the market more. Data was poor, unemployment claims was not good. The central bank event from yesterday also really did not help the dollar so much. So we believe that one way or the other, we cannot say the dollar is not going to be weak anymore. There is still every possibility that the dollar could still weaken further in the markets. Now, what would the weakness of the dollar mean for Euro USD? If dollar weakens in the market, Euro USD should rise. If dollar is going to continue to be a weak currency, naturally, Euro USD should recover, it should rise. Which means I have done step number one. I have established a reason why I think Euro USD should rise. I think it should rise because dollar is not having it so well right now because of some certain reasons. Bad data, also central bank events was not good as well, even though Trump just had a nice victory on Wednesday. But currently, the market isn't feeling so much good with the dollar. So I have established the reason why I think Euro USD should rise. Two, I need a good level of support, right? I'm not going to look too far. There's a great level of support somewhere around here. There's a good level of support around here. We've seen this. We've seen this. So if now price breaks and then it's testing this level now as a support, right? So this level support, this level also support, which means this is also acting as a support here. So if a reversal pattern is forming around my support zone, I am going to enter my buy. Get it? Does it make sense now? If a reversal candlestick pattern is now forming around the zone that I intend to use before, that's confidence. So the idea is establishing the reason why you're looking for that upside, joining and looking for a good level of support. If you find any of the reversal candle patterns that you know, especially for a buy around that level, that's your answer. That's an opportunity to buy. Not just because you saw the pattern. No. We've now done what makes sense now. We've established the reason. We found a good level of support. And then we're seeing a candlestick pattern on the level. That's the idea. That's how it gets better. The same thing goes if it was a resistance. All you need to do is establish that there is a reason why the market wants to fall. Then find a nice reversal pattern showing around it, and confidence comes in to enter into your trade. And for one, another thing that is giving me even another renewed assurance in this level, even without the reversal pattern or anything, is chart patterns itself. One of the most interesting chart pattern to me, when I was going through my research this morning, because I'm not so much of a fan of technical analysis, so I know it, but I don't like the official names. I saw something like staircase, an ascending staircase. You know, an ascending staircase, and also a descending staircase. I saw that online. I was like, wow, there's something like this. But listen to this. You see, one thing I need you to understand for me is one of the best things you can do for yourself in terms of trading chart patterns. We're going to go through a few of the common ones, but for me, one that I really love so much and I really hold confidence in is the one that has already been established by price structure in form of what establishes trends in the market. For example, the concept of how a previous high should be or should become the next low, and a previous low being the next high. I love these two so much. I'll explain it. This for me is one of the best chart patterns you can trade. Every other one for me might be secondary. Every other one for me might be secondary. I love this one. Particular one, I love it so much. How? What am I talking about? When the price rises, it will get to a point. It will definitely need to change direction by a little bit. Like a cooling off period. And this is going to be the high. That's the highest point it got to. But eventually, because the market knows we are still going up, we're not going down, we're going up. We only took a small space to breathe. So we know we are going up. So eventually we go up. But when we go up, it is natural for us to believe that This previous high should also help us as the next low, which means we expect that price would come back to this place as the next low before it continues to go up. And that way, every highs will continue to be the next low. And in practical sense, this is how a trend is usually created in the market. So this is what I mean by previous high being the next low. This is what we mean by previous high being the next low. And then when we say previous low being the next high, it's the same. A lowest point somewhere here when prices are going down, right? And then simply price moves back up, gets us this, and then it continues to go down. But we expect that this previous low will then serve as the next high for price to continue to go down. And this way, price establishes a trend. That way, lows becomes highs that way, right? So only for me to see this morning that it has a name and that it is called ascending staircase or descending staircase. That if I found it really funny too. I just know it as trend formation, as a simple chart formation in the market. And this is actually what backs the concept that everybody know has break and retest. This is what backs that concept. This is exactly what backs the concept of break and retest. That is, when a level breaks a previous high, at this point, it is expected to retest that broken level. So after every break, we expect that the last highs will become the next low. This concept of break and retest was gotten from this chart pattern. That every single time price is able to go above a previous high, it should use it as the next low. That's the concept of break and retest. I told you everything can be explained. Just have the understanding behind the concept. After every break is when a high will change back to a low, but it is still the same concept of when price breaks a level, it retests it before it continues to move lower. Now, let me show you something in practical sense in terms of trading chart patterns. Look here, look here. We've established that possibly there's a reason why we want to actually buy Euro USD. But don't forget, when Euro USD was crashing, this level was a level of resistance, right? Before. When price was a support before, at this point, when prices were going down, when it got to this place, ordinarily we expected to see some elements of pushback from buyers, but because the volatility in the market was so high, it was able to go beyond it, which means this level is no longer a support now. It has become a resistance. Now that prices are also moving up, this level was supposed to stop price and send it back down, but it could not. Price was able to go above it, which means already price has broken a resistance. There's a breakout at that point. Price has just experienced a breakout at that point. Now listen to this. Look at this now. Right? Pay attention to me. Price goes, it breaks above a resistance, right? Start from here. So we are starting from here now. So let's call this point, this one now, here. So let's say this point and this point is the same now. So watch. So after a breakout, right, price establishes a new high, but then goes back to retest the level it has broken. So we look at this and we are going to see this. So if you look at this, naturally, it means from this same level, according to this here, prices should rise. And when price is rising, it is expected to go beyond this next highest point, which means even this high now will still be expected to serve as the next low for price. And that way, I'm still going to expect the price will come back again up to this point and also move above this high point at least it gets back to somewhere around here. You can see that I have drawn a future price movement from an established price pattern. Now look at it from here. I have just mapped this exact pattern with a future price movement, like market that has not happened. Which means I can also enter this trade from this point, not because of a candlestick pattern now, but now even because of a chart pattern. That, oh, after you have broken this level and you have come to retest the level, as the next low, good. Price should still rise. And when you also rise, I expect that you also get to a point you will stop. And when you stop, you will still come back to test this previous low, which means I have an entry point here for a buy. I also have an entry point here for a buy. I have two entry points. I have two entry points. But don't forget, the pattern itself is not what we are trading. What we are trading is the idea that dollar has some issues it's dealing with now, which means it could potentially continue to lose value, and then euro can recover against the dollar. I am only using a pattern as the bedrock for entry, not for the decision. So I am not drawing a pattern to determine if I should buy or sell. I drew the pattern to determine entry. That's how to make these things work better in the market. It could also work for a downtrend if we find a downtrend. It is important. Oftentimes, all we need to do is find the backing. When we find the backing behind the move, there's a lot you can do with the chart. The reason why you think your chart analysis does not work is because you're not finding the backing for the move. Find the backing. Find the backing. Another one of my chart patterns, you can see we're not using some of the elaborate common ones because we found out that some of them might not have the highest success rate in predicting the market. Most of the most functional chart patterns with good success rates in the market shouldn't be complicated. I hope you know that a trend movement is also classified as a chart pattern, right? If a market moves on a trend like this, that movement is also expected or called a chart pattern, which means you can expect the formation to continue, right? So like that. Well, that's what I'm just telling you, right? That even a trend movement is classified as a chart pattern. The fact that it is established on the chart is why it's called a chart pattern, right? So you could find an uptrend, you could find a downtrend, whatnot. But for us, one of the most popular chart patterns that we like is the trend line, uptrends, downtrends, as the case may be. Let me see if the one on pounds USD that we saw the last time is still functional. Oh, great. Although this is one level that has been breached recently because of the elections, right? But if you look at this is a sweet chart pattern. Honestly, naturally, the next time price leaves here, it is expected that it will go beyond the previous high because this is the previous high area, right? And this is another one here. So naturally, you can see that movement. In fact, look at it again, Seth. Look at the example of how a previous high still became the next low here. Look at it. Look at it here. Price goes, tests this, comes down, goes back up, and used the same place to go up. You can see what we're talking about. How a previous high can always be used as the next low for price movement. That's the idea. So, but usually backed by market information. Usually backed by market information. But I want to talk about this one. Look at this one. Look at this one, right? Price goes, comes, it goes, it's down here. We could see that that level has been breached twice. And because of the election, it was breached well, but the next day again, price recovered back up, more or less like a false break, but not of equal measurement yet. But let's drop down a little bit to a smaller time frame. Let's see what we have. Now, when you look at this from the 4 hours time frame, you notice some things that one way or the other, price has now clearly gone above the trend line. And it looks like market is just looking for a retest of the level right here. If pounds is assumed stronger than the dollar, this is naturally going to be the best place to start the next uptrend or a continuation of that pattern on pounds USD. That will essentially be the best place. But the question is, do we really believe that pounds is currently better than the dollar or could be better than the dollar? The issue is, yesterday as well, the Bank of England also held its monetary policy meeting, decided they were going to cut interest rate as well, but also some dovish statement also isn't helping the pound stand out so much in the market. So it is now a question of what the market believes to be between the pounds and the dollar, which one would eventually be separated out when the market resumes next week. But I can tell you something, if the market is separating the dollar from the pounds, making the pounds a stronger currency, this will be the best place for us to get in on further upside on the pounds, banking on the fact that there should be a continuation in the strength pattern on the asset. And then if you also see something here, you'd see that there is a rejection even on the daily time frame, clearly showing this. That, okay, it looks like some buyers are really probably interested in this, and this could probably be the next level to start the continuation of the uptrend. There's a lot to still talk about, but we can't exhaust it. So what is going to happen is there is going to be a discussion on price structure again, chart patterns, part 2. Because we've been on the live for almost 1 hour, 46 minutes already. So there's going to be a part 2 because naturally you cannot exhaust these things in one sitting, and we're constricted by time. There's going to be a part 2 for this event. There's still a lot of patterns that we can still look at. For me, one of my personal favorite, the W pattern, is one that I love so much. Really love to trade the W pattern a lot, but also backed by market information. Maybe one of these days we're going to teach you the M and the W pattern as well. So we're going to be having a part 2 of this particular price structure webinar. I'm sure I'm going to write it in now that we need to have a part 2, but we have to close. We've been here for over almost 1 hour, 50 minutes already. But I'm not also going to close without questions and answers. So please, if you have anything you want me to talk about quickly, use the Q&A box so that we can do that. But on that note, we're saying goodbye to our online audience. Thank you for joining us today. We'll see you again sometimes later. Bye for now.